do expect this to be very difficult times, certainly the most difficult times that anybody that's alive today has ever lived through. I mean, there's a reason everyone's so scared and stocking up on supplies, guns, ammo. Same thing with gold and silver. You can't actually get a lot of silver right now, even if you wanted it. So we've never witnessed what we're about to witness.
Hey everybody, I'm here with Mike Hananel, and Mike, you've got an illustrious history here. I'll introduce you. I'm going to read from the bio just so I don't mess anything up. But as a CEO of Strategic Growth Real Estate Incorporated, a commercial real estate brokerage, investment, and property management firm that you founded in LA in 2012, you have brought nearly 30 years of entrepreneurial experience in business operations and real estate management to the table. You're a third-generation real estate investor. You're a second-generation real estate broker, and you've pretty much got a lifetime of experience then, including in 2006, you founded WNY Metro Horizon in Buffalo, New York, a company that you grew to over 600 apartment units under management before you sold for $36 million in 2015. You were a devoted student of the economy, money, and monetary policy. In 2005, specifically, you foresaw the housing crash. You anticipated a massive downturn in the housing market in Los Angeles and nationwide. You began selling your entire portfolio in LA, including encouraging your clients to do the same. And then you began researching markets all around the United States to see what market would be as recession-proof as possible, or what market was undervalued. And you found Buffalo, New York fit your investment criteria perfectly. You opened an office there, you began making investments in 2005, 2006 there, and you brought a lot of your LA clients there. And when you began investing there, this is a stat that I thought was really cool. When you began investing in Buffalo, Buffalo itself was ranked by Moody's as the 72nd best real estate market out of the 100 largest cities in America. And when you sold in 2015, Buffalo was rated by Kiplinger's Finance magazine as the #1 real estate market in the country of the 100 largest cities in America, specifically during the Great Recession from 2007 to 14. Your clients who invested with you made an average overall return of 312% or 34% annualized during the Great Recession. Wow. So, I'm sure you love that intro there. I'm fascinated. What did I miss? Who are you, Mike? What else is there to add?
Yeah, I mean, I guess just, I think you covered most of it. The Buffalo thing was interesting. Of course, I never anticipated going into it that it would have been the #1 on that list. But there was actually only 3 markets in the entire United States that continued to have appreciation, not depreciation, during the Great Recession. Every other city, this is of the 100 largest cities in America, every other city in America had declining prices during the Great Recession. So only Buffalo and 2 other markets, and those other 2 were San Antonio, Texas, and the other one was Houston. So 2 in Texas probably kept stabilized because of the oil industry there, and Buffalo was #1, which of course I hadn't anticipated going into it, but a little bit of luck and a little bit of foresight led to an amazing outcome. So, but yeah, I guess now in this very turbulent time, I feel a little, grateful, I guess, that I did sell the Buffalo portfolio, because I used to spend, every month going back and forth, flying back and forth to Buffalo to oversee that. And now with all the travel restrictions, it would have been difficult to keep maintaining that. So I guess I'm feeling lucky today.
Yeah, absolutely. And, as you mentioned, we're in turbulent times right now. The majority of this call, I do want to focus on where we are now and what it looks like moving forward. But with that bio, I cannot help but ask for a second. Could you dive into how you chose Buffalo, and maybe not specifically Buffalo, but what were the strategies that you were taking in 2005? And maybe not necessarily how did you anticipate the housing crisis, because in hindsight, that might be a little bit more clear. But in 2005, what were you looking for?
So I was, during 2005, the Federal Reserve was actually raising interest rates. So they had started in 2004 to 2006 because they thought that markets had gotten too frothy, and so they were trying to tighten monetary policy. I was absolutely convinced that that was going to lead to a big downturn, which is what led me to search. What intrigued me about Buffalo and what I was looking for were markets that hadn't been bid up as much with speculators during the good times. Places like Miami, Las Vegas, Phoenix, I felt were highly speculative and overly overbought during the good times. And then I felt that if there was a nationwide downturn, that those markets would get hit worse. So those were the opposite of what I was looking for. I was looking for secondary, tertiary type markets that maybe others had forgotten about or hadn't discovered that would have fared better during a nationwide downturn. Buffalo at that time had already had about somewhere between 25 to 30 years of constant appreciation. I mean, prices had always gone up for 30 years in a row. That means they made it through multiple recessions, whether it was at that point, the 2001, 2002 NASDAQ crash or the mid-90s, which were really brutal for Los Angeles real estate, which is where I'm from. During those years, Buffalo kept going up, whether it was 1% or 6%, but somewhere in that range, small amounts. And so it was slow, steady growth. The other parts of Buffalo that I really liked was the local developers. They were buying entire buildings that had been abandoned back in the late 1970s, early 80s, because Buffalo had been a blue-collar town, and a lot of the jobs had left and gone overseas. And so it went through a really, great downturn during the late 70s and into the 80s. And so by the time I found it in 2005, it had already been at its worst and had been slowly coming back. And a good sign of where the market is when you have local developers that are buying buildings that had been abandoned or vacant for at least 20 or 30 years. And now, after all those years, they decided it was a good time to buy these places and turn them into apartments. And when they did, there was a waiting list 6 months out for people to get an apartment in those units. So there was a real demand in the urban downtown core for units if they could just be, developed. And so that's what really intrigued me about it. So we were buying units that were really in bad shape, deferred maintenance, had a lot of deferred maintenance, but that we felt we could really bring up a notch, bring it to upper middle level type apartments. Wouldn't be as high-end luxury as the stuff that these builders were taking abandoned buildings and converting into, but would certainly benefit from that kind of demand that they weren't able to supply enough apartments for. We would have that aspirational type of tenant come to our units that, younger people that wanted to move back into the urban core. Also, of course, there's been trends for years of people moving back into urban cores. Honestly, I think now with the COVID pandemic, we might actually see those trends reverse, because now who wants to live in close, urban quarters when we have to have social distancing? So we might actually see those trends reverse, but for up until, about a month ago, more and more people have wanted to move into urban core. So all of those factors is what led me to invest in Buffalo.
How much of that was derived by workforce opportunities? You mentioned that it was a blue-collar town that had kind of lost its manufacturing, and that was really the blight that hit it in the 70s and the 80s. I mean, did you just pick a town that said, hey, I think this is undervalued real estate, or was that kind of also supported by the fact that, hey, there's employment opportunities here, there's big industry that's coming in? What did that look like?
Yeah, so that market also had a very diverse economy. So certainly a big part of my research was what is driving employment here, or is there employment? Because at that time, Buffalo was still the second poorest city in the nation, next to Detroit. I think now it may be third, actually. It's made its way up a notch. But the economy was very diverse and driven mainly by three factors. The three factors were education. The largest New York State University system, in the State University of New York system is Buffalo, is the Buffalo University. And then, of course, there's also Buff State, which was another one, but there's a lot of other private colleges and universities. So education and students were definitely flocking to Buffalo. So that was one of the drivers. Also, at that time, banking and finance, I think the 08-09 crisis definitely changed the landscape. But up until that point, when I started there in 05, banking was a very big key driver in finance. HSBC actually had its U.S. headquarters in Buffalo, and the tallest tower in downtown at that time had its namesake, the HSBC Tower. Since then, of course, it's changed. It's no longer even called that anymore. But also KeyBank was there. There's a bunch of other, big banking operations happening there. Also, I had seen that Warren Buffett through Berkshire Hathaway was investing in Buffalo. Berkshire Hathaway has owned the Buffalo News forever, but also they were putting Geico operations there, and they still have their big call centers and customer service centers in Buffalo. And then the other piece of it was biotech. Roswell Cancer Institution is one of the largest cancer research, institutes in America, and they're based there. But a lot of biotechnology and even nanotechnology was being developed in Buffalo. It later piled on, and New York State actually then gave $1 billion grant towards the city, which then spurred yet another $8 billion of new development. Since then, Elon Musk has gone there with Solar City manufacturing. And so we've really had seen the Buffalo, economy booming and coming back to life during that time. Unfortunately, I've already been hearing rumors that a lot of those institutions have already been making layoffs with COVID. And being that, so much of that tenant base was workforce housing, and now a lot of layoffs are happening. I fear about what's happening with what will happen next with that market. But during the years that I was there, I happened to catch it at just the right moment.
Nice, man. Well, you mentioned COVID. So what's happening right now? As of March 30th, that's today, and as of 10 a.m., we have 739,000 cases worldwide, 35,000 deaths, and 156,000 recovered. Compared to 2 weeks ago, March 15th, worldwide, we had about 169,000 cases. So significant growth there. Highly doubt we're at the worst of it yet, just because the lag on testing, just specifically. Hopefully some of the measures in place are going to, kind of slow that growth down. But we're getting crushed here. I mean, and the economy is really getting crushed because we're having to shut things down. It's just healthcare's winning right now. And, the Dow dropped almost 25%. Actually, even with the recovery that it's had in a couple of recent days, I think roughly 22,000. I haven't watched what it's done today, but it's been a massive shock. And there's some people that are calling it the pin to the grenade. So, looking at it, with you specifically, how has it had an impact on your investing, and what does your portfolio look like now, and what are you looking at with coronavirus, and how does that impact you?
Well, as it relates to real estate, I since selling in Buffalo 5 years ago, I've been adding to my Los Angeles holdings, which is where I live, where I'm from. I've always lived here throughout, and so. Now I'm definitely on hold. I'm not going to make any additional acquisitions. I'm not even going to look at deals for the time being, until the dust settles on this. And I think that'll be many months out. If anything, probably minimum 3 to 6 months out before I would even consider making a new investment in real estate at this moment. And it could go as far as a year to 18 months before things actually finally bottom out. I'm expecting the economic fallout to come in waves. And I believe we've only had the first wave, and I think there'll be another shock and another wave down. And by the time a lot of the defaults start making their way through the system, and then the financial institutions have to figure out how they're going to respond to all of that, I think we've got many, many months ahead. So, the only thing I've actually invested in is in adding to my silver holdings. I've already got, gold and silver as well. I've always said to investors, it's probably prudent to put at least 10% of your net worth in gold and silver, really just a hedge to protect all your other investments. Most of my net worth is still in real estate. I'd say about 50% or a little more maybe. And that might be changing as the values, change. We don't really know yet, but I'm expecting values to drop. So, I'll be waiting for some time before I make any new investment decisions. Really, what I'm more concerned about right now is just triage and dealing with my existing portfolio, as I believe there will be a wave of shortfall of revenues from tenants. I think tenants may not be able to pay rent, and it might be severe and it might be dramatic. And so, I'm focusing all my efforts right now on my operations, since I do own a property management company and I manage my own portfolio, but we also do third-party management. We manage about 300 units here in Los Angeles. So we're a small, medium-sized boutique operation, but about 2/3 of those units I don't have any ownership interest in. And so, I'm also managing for my clients, and we're going to do the best we can. Now, we had just come off of literally the best quarter we've ever had in terms of rent collections, occupancy, so everything was literally perfect up until a month ago. April 1st is not here yet, so we really don't quite know for sure what the impact will be until we see how many tenants pay or don't pay their rent. I'm preparing for the worst. I'm hoping for the best, but I'm preparing for the worst.
What is the worst?
The worst is that large percentages of tenants can't pay their rent due to unemployment. We know that.
What percentage do you think will be the worst?
I think it's going to be at least 20 to 30%, but I could be as bad as 50 to 80%. It really could be as in that range, Now, I will say there's one good thing we have going for us here in Los Angeles and in certain other markets, maybe New York, and that's rent control. And you'd never thought you'd hear a landlord say that rent control is a good thing. It's actually not a good thing. Typically, overregulation by government always leads to worse problems of the exact things they're trying to regulate. So having rent control in LA has led to all-time high rents. It didn't actually have the impact the government wanted, which was to keep rents affordable. It actually made market rents go far higher. So in my view, rent control, always will backfire because it reduces supply. It reduces people's, investors wanting to produce more units because they'll be under rent control, although at least the new construction had not been under rent control, but now California has a statewide law that just started January 1st, which means all buildings after 15 years will become under rent control. So even if you build a new building, it might be fine for 15 years, but it is literally, as the day it becomes 15 years old, it is now subject to our state new rent control law. So the only good thing about rent control, however, is that if, let's say market rents have gotten up to here and my very low paying tenants are paying rent here because of rent control, and they've been in the units for a long time. Well, if market rents drop, which I expect they will now, my tenants are still far below the new market rent. So where I have high market rent tenants, which I do have some, right? If tenant moves out, I renovate, make the apartments real nice, and I rent it at market rents, I'm expecting I'll have to drop those rents to keep my good tenants. I expect market rents will drop due to all of this. The good news is I don't think it'll drop enough where my really low paying tenants are going to have any incentive to want to move out because they'll still have to pay more rent elsewhere. So in a crisis, and we actually saw this during 08, from 08 till 2011 when rents in LA finally stabilized and then started going back up, market rents dropped in some cases, 10%, in some cases 20%, really depending on what part of the city you're looking at. But the low-paying tenants, the rent-controlled tenants, they never left and they kept paying their rent, right? And so those get you through the difficult times. So if there ever is a good thing about rent control during a downturn, those are your steady tenants that actually still pay the rent. So I think that, if let's say 70% of my tenants are below market rent, I think those tenants for the most part will still pay. I think we still might lose some of those tenants. But all the market rate level tenants, those rents are probably going to fall.
Sure. In terms of a direct impact, if, let's say a number of them, don't pay rent or, I guess, how are you responding let's say April 6th comes around and you have not received rent from 20% of your tenants, or maybe people are already reaching out now asking for forbearance. What is your response to tenants when that happens? And then afterwards, I'll ask, how are you working with investors and lenders?
Yeah. So we actually developed a rent action plan. So I've got that right here that I distributed to my team. And basically, we're kind of going step by step. So if somebody contacts us and they can't pay their rent, the first question we'll ask is why. And the reason is because the governor of California has declared via executive order, and there are similar orders in place from LA mayor as well as other cities we manage in other cities quite right around LA, like Inglewood and Santa Monica, West Hollywood. Each of those cities kind of have their own rules, but there's a statewide executive order from the governor of California placing a moratorium on all evictions through May 31st if the tenant can prove that their lack of income is directly due to COVID-19. So either they were laid off because of COVID-19, or their hours were reduced, or they were furloughed because of COVID-19. Also, it says if it's due to the government's response to COVID-19. So it could be that because schools were closed in Los Angeles, and now those parents have to pay for childcare because, let's say, they can still go to work, which only essential services are allowed to operate. So if you work in a restaurant, you can't go to work. If you work in any kind of entertainment, you're not able to work. Places like movie theaters, sporting events, concerts, all those places are shut down. So if you're unable to work, or your expenses have incurred higher expenses due to childcare costs, or because you're taking care of someone, again, directly related to COVID, there's a moratorium on evictions through May 31st. So the first step we're doing is asking the tenants why they cannot pay. And if it's due to COVID, then we need some form of documentation to explain why that has occurred. Also, because the governor has stated that he's asking all banks, commercial and residential, to halt any foreclosure proceedings if income is reduced due to COVID, and therefore you cannot pay the mortgage payment, whether it's commercial or so it could be a retail strip center and the stores are shut down because of the orders to stay in. Or to shut down. A lot of restaurants, a lot of places are ordered directly to actually shut down by the government. And so, again, there's a statewide order for banks to not begin any foreclosure action, at least until May 31st, if income is reduced due to COVID. So we're gathering documentation from tenants so that we can use that for the lenders on our buildings as well as our clients' buildings to ask for forbearance, and they're going to ask, in some cases they're going to ask, not all. Some lenders, by the way, we've already been reaching out to have automatically given forbearance for 60 days or 90 days. In some cases, they're just delaying payments, saying you don't have to make your payments for 2 months or 3 months, but you'll still have to make all those payments on the third month. Like one of my lenders said, June 1st, I got to make all 3 payments at once. So there's no additional interest or penalties being charged, and it will not affect my credit, which is great. But on June 1st, I still have to make all 3 payments at one time, hoping that maybe by then tenants are back to work and they're able to then make up their lost or unpaid rent. So that's the first step, is to validate whether or not they've lost their income directly due to COVID, so that we have the documentation to provide to our lenders. The second question we ask them is if they've already applied for unemployment. And if they have, we'd like copies of their unemployment documentation so that we can see what their income had been and what their income will be. We know with the $2.2 trillion stimulus package that the president just signed on Friday, they're going to add an additional $600 per week from the federal government to whatever the states allow for unemployment. Every state has different unemployment insurance and different unemployment rates, and so in some states it's worse than others, but now whatever it is, the federal government will add this $600 on top of it. So we want to see what is the, unemployment benefits the tenants are going to be able to get. and that'll weigh into our decision as to how we allow them to defer their payments, their rent payments, or to make payments. But obviously, if anyone's affected by COVID, we're working with them. And the governor has also said to everyone in the executive order that even if we cannot do evictions due to COVID through May 31st, the rent will still be due, and it will have to be made up within 6 months after the executive order expires, which right now is May 31st. But again, they could even extend that depending on how the pandemic, goes. So that's basically how we're starting. That's sort of step one. Step two is we're going to then ask our tenants if they, we don't currently offer payment via credit card or PayPal, but we're going to offer that as an option. So, and there will be additional fees that we get incurred, but we're not going to pass that on to the tenants. A, we don't think we'll be allowed to by governments, and B, especially in rent-controlled markets, if you add a 5% fee or some kind of fee, which we're actually going to get charged by PayPal or the credit card merchant, banks, we're going to just have the landlords eat that cost. I actually just sent an email to all of our clients letting them know. Now, if they don't want to incur that cost, then we won't offer that to their particular tenants. But certainly on my buildings, I'm offering that as an option to pay rent with a credit card, and we'll eat those additional fees. Another option we're going to offer to tenants, and again, in a rent-controlled market, normally we would never do this, but we'll offer the opportunity to add a roommate to their lease. Maybe they can bring in a roommate and find a way to pay that way. Normally, we increase the rent as rent control allows us to do in Los Angeles if there's a roommate, but we won't do that this time. We'll just allow them to bring in a roommate. Sure. And then, of course, other than that, it's going to be, offering payment plans and putting it in writing as to how they're going to make up the back rent and at what date they will. And of course, this is a rolling, crisis. So all of this may have to be changed or extended as things develop, and as as we really can assess how bad the results are with tenants paying or not paying rent.
Sure. And you kind of answered it in that process there, but you're compiling a lot of documentation, and then you're working with, your lenders and whatnot, and saying, hey, listen, here's what's going on, and here's proof of it. What about investors? Do you have any investors in any of your projects, or are you the only investor now?
Oh, in my deals, I have partners. I mean, most of my deals are just a partnership. I either own it myself or I own it with one partner or two partners, but they're not, I haven't done syndication since I sold the Buffalo deal because the yields have been too low, especially in Los Angeles. Our cap rates have been so low. There's not enough cash flow to really merit doing syndications. Sure. Although, 6 months, a year down the road, who knows? I mean, if cap rates actually start to really rise, then, because landlords expect a higher reward, risk reward for their, risk in this type of a market with, potentially rampant, credit defaults and tenants not paying rent, then maybe, there'll be opportunities down the road. But yeah, right now it's just me and a couple of small, partnerships.
Well, the reason I asked that is short-term asset management strategies. Are you halting distributions? What does that look like? Are you holding on to more cash? How are you preparing? So you already mentioned the tenant strategy. You mentioned how you're going to work with lenders potentially, but now your personal financial strategy. What does that look like in terms of, how much cash are you holding? How much runway are you depicting? That you'll need or planning for it, and what does that look like? And then kind of as that, growing from the short term, how will your long-term, i.e. 6 to 12 months and beyond, look like? You mentioned there's going to be waves. So if there's going to be another, let's say we come back from after coronavirus and then we go back down because of defaults, and then we go back up because of something else, and we go back down. What are your strategies, your asset management strategies in particular moving forward?
Yeah, so I've immediately implemented, what I like to call triage, which is, every non-essential expense has been eliminated. And, the good news, I guess, if there's any good news, is that I've been preparing for a downturn for quite some time. The last several years, I've been expecting that there will be a downturn. I've also expected that the next downturn was going to be worse than the 08 through '09 crisis, most people thought I was nuts and said that was impossible. The next recession will be mild. It'll, forgetting about pandemic for a minute, everyone said, oh, this next recession will be mild. We're going to bounce right back. Everything's going to be fine. And I've always said, no way. And it's because the amount of debt in the world is literally more than double what it was back.
Long-term debt cycle.
Yeah. And it's more than double in the world what it was in 2007. In 2007, the entire world, including governments, corporate bonds, personal debt, cars, mortgages, just add it all up, it was 112 trillion worldwide. Now, going into this crisis, it was 250 trillion. So, with way more derivatives, and, the big banks that were too big to fail are now much bigger than they were, and there's much fewer of them. So I've always said that the next crisis, whenever it occurs, was going to be far worse than the last. I've been preparing for that for years, which means in all of my property accounts, I have record amounts of cash on hand. I've been, doing distributions, but on a very limited, mitigated basis, and building up reserves. So all my building accounts have, large reserves. My property management company has the most, cash we've ever had. Personally, I probably had more cash a few years ago because I've made investments. But, now we've stopped all unnecessary expenses. And the same thing with our buildings. If the rent money doesn't come in, it's certainly not going to go out. And luckily on most of my multifamily properties, I have non-recourse mortgages, with single purpose LLCs set up. So if, worst case scenario, one particular building, I actually have, for example, one building that has all market level rents. And that's because I bought it from somebody who had, paid a lot of money to the old tenants to move out, and then, remarketed everything and rented it all out at market rate. So the cash flow has started off great. I mean, it was a 6.5 cap rate in a market that's normally at a 4 cap rate. So we bought it well with cash flow up front, but now I expect nothing but declining revenues because these are the kinds of tenants that won't be able to probably pay their rent, and I'll probably have to reduce their rents to keep them there, and they're all at market level like I was explaining earlier. I have another building that is all 9 out of 10 units are all below market rent. I've tried and nobody's moved, and they kind of just stick in this building. And so I think that one actually I'll have better cash flow than the building that has, up until recently had better cash flow, because the market rents will go down and the low tenants hopefully will stay and keep paying. And so that's why I set up every property with a separate, dedicated LLC and do non-recourse financing. Because, if I have to, I'll walk away from one building, but I'll keep the other building, and, it won't affect my personal credit. The bank can take, the one building, and I'll keep the other one. I hope that doesn't happen, but like I said, I always like to, prepare for the worst. I try to expect the best, but prepare for the worst just in case. And now it's proving to have been a good strategy. We've been staying in. We haven't been going. The only thing we've been spending money on is food. And normally my wife and I travel quite a bit, and we take our kids to, exciting places around the world, and or at least for the time being, we're not doing any of that. Anything that's unnecessary is being cut out. And I'm doing it because, like I said, even if we feel like we're getting out of this, I expect there'll be another wave down and maybe another one after that. So I'm preparing for the long haul. But I will not be, like I said, if the rents don't come in on each building, the money won't go out. I mean, I won't pay, for example, even the utility bills if we don't have enough money in that account from rental income. The good news is the governor has also put a moratorium on utility shutoffs due to non-payment, at least until May 31st. So they can't shut off the utilities due to non-payment either. I think the cascade domino effect on this is going to be horrendous. I mean, even if the government keeps bailing everybody out, there's still going to be defaults. There's still going to be a lot of mortgages not getting paid. There might be banks failing. It doesn't matter to most people because unless you have more than $250,000 in an account, it's FDIC insured. So you shouldn't worry about your money in the bank. Because normally what happened in '08, for example, we had Washington Mutual here in Los Angeles, Friday night they closed and went bankrupt. Nobody knew about it till Monday morning. And then they just announced, oh yeah, WAMU went bankrupt. But don't worry, Chase Manhattan Bank has acquired all their assets for pennies on the dollar. So literally Monday morning, our accounts just reopened under Chase, and your money is all still there. So, the Fed obviously is going to continue to print money. They've even now announced last Monday, they announced they'll print unlimited quantities of money. So that's never happened before. I mean, we thought quantitative easing was an unknown experiment, which it was after the '08 crisis, but then they printed 3.8 trillion over 6 years from 2008 to 2014. They printed 3.8 trillion. Now they've already printed more than $4 trillion, and it hasn't even all made it through the system. But you'll see the balance sheet, the Fed's balance sheet has already skyrocketed. It's already now over 5 trillion. It's going to go probably to 6, 7, 8, maybe 10 trillion. So we have no idea the consequences of all of this. If I had to project out, I think the initial consequence will be a massive deflation, which they're fighting with money printing, but they won't be able to win the battle because there'll still be defaults. And then after all that makes its way through the system and things stabilize, it'll then turn into hyperinflation because all the money printing, eventually that money has to go somewhere. During the '08, '09 crisis, all the money printing, most people say, oh, well, we never had inflation. That isn't true. We did have inflation. The inflation all, however, went into stocks, bonds, and real estate, right? Now we're going to see inflation into all goods, including consumer pricing, especially once people are freed out of their homes and they go back to spending again. And if they get a bunch of free money from the government, and supply chains are also being shut down by governments and have been, especially in China. So you have a reduced supply chain, you have reduced products being produced and services, and then eventually you flood it with additional cash. All that cash then starts to chase these reduced services only when people start feeling better again, or they got their job back, or they're going back to work. That's when we'll see the inflation. I think they could get out of control and it could turn into a hyperinflation like we saw in the late 1970s. So we'll see how it plays out, but I'm prepared for all of those scenarios. And really the best way is A, having plenty of cash on hand, and B, in my view, having gold and silver, because with hyperinflation, gold will run to the moon. So, we even saw it in '08, and initially gold prices dropped, but then gold prices went up. It went from $1,000 an ounce at the beginning of the '08 crisis down to $700, so a 30% drop. But then as soon as QE started, it went up to 1,900, more than double. So I think we'll see a similar pattern again with gold.
All right, so we've kind of jumped into a couple of the other questions that I had here. I want to be respectful of your time.
Of course.
I guess, do you have a couple more minutes here?
Sure.
So I guess the final question that I'll really dive into, you mentioned that we might see some waves here, and you think we could potentially go into hyperinflation just because of the amount of money printing. Paul Volcker back in the 70s, and correct me if I'm wrong, raised interest rates significantly, much to everybody else's, chagrin, or, everybody else was angry at him, right? Everybody was pissed at Paul, like, stop doing this. And then, of course, a decade later, they're like, wow, Paul, you really did what needed to be done. Right now, reading a lot of the stuff, Ray Dalio thinks we're in a long-term debt cycle. Ray thinks that we're not going to be able to raise interest rates like we have in the past because of the amount of worldwide debt. And Ray writes about a changing world order. And, I've tried to be as optimistic as possible, and I don't want to get too much into the potential, or the severe potential. But I mean, what does this look like? Can we raise interest rates? How do we combat hyperinflation? And what is that? And then, but of course, that could go into huge discussion. How does that specifically impact real estate and multifamily? I know you're renting out to residents, but multifamily is probably considered commercial real estate because it's financed by commercial loans, and so commercial real estate is directly impacted by federal interest rates. So I'll stop. What does this look like? How do we combat this?
Yeah, you're 100% correct. If Paul Volcker hadn't done what he did in the late 1970s up until 1980, the inflation of the late 1970s was already getting out of control, and it would have turned into a hyperinflation. When hyperinflation gets out of control, basically what that just means is a loss of confidence in your currency. So it's
Right.
exactly what has happened in Venezuela. You've seen it in Zimbabwe. Of course, everyone knows about how Hitler came into power because of hyperinflation, because the Deutschmark literally inflated, during the Weimar Republic, the Deutschmark inflated to a value of zero. You needed, 100 billion Deutschmarks to buy a loaf of bread. You saw pictures of people with wheelbarrows.
Burning their cash.
Yeah, and one guy left his wheelbarrow out in front of the store. He came back. The cash was dumped out onto the ground, and the wheelbarrow was stolen. So yeah, that just goes to show you what happens if things get really out of control. Now, I don't know that that'll happen here because, at least currently the dollar is still the reserve currency of the world, although I expect that that status is definitely going to disappear. It's already been slowly being reduced as the world's reserve currency, but this will certainly probably hasten the demise of the dollar. You're right, though, that even though Paul Volcker raised rates to, at some point, 1980, rates were like 20%. Like you wanted to get a mortgage on your house, you had to pay 18 to 20%. I found some, when I was clearing out my mom's house a few years ago, I actually found some newspapers from 1980 that was advertising, really great mortgage rates, only 18.5%. I was like, wow. And I actually, I have it somewhere. But the difference is that the world didn't have the kind of debt problem that it has today. And so that is why today, if that were to occur, and yes, the only way to solve hyperinflation is to raise interest rates, because when there's a loss of confidence in your currency, meaning nobody wants to buy your treasury bonds, the only way you get people to buy your government treasury bonds is to raise interest rates up and up and up until finally people say, wow, well, they're going to pay 18%. That's pretty good. I'll double my money every 3 years at 18%. I guess I can take a risk on the dollar, and you get investors back into the currency. And that's why it was the right move for Paul Volcker to do it, even though in the interim, it did crash the stock market, the bond market, the existing bond market, because nobody wants to hold existing bonds when the new bonds are paying much higher interest rates. So it crashes the value of the existing bonds and rates go up. And it crashed the real estate market as well. And so now if they have to raise rates to save the currency, it crashes the whole world. So I don't know where that ends. I mean, people talked about a debt jubilee. Will people allow a debt jubilee to happen? I mean, the Chinese own 1.1 trillion of the U.S. Treasury market. The Japanese own about the same. So those are the two largest foreign holders of the United States Treasury market. If you inflate the value of the dollar so quickly that it becomes worthless, do they get mad? Does it lead to World War III? If you have China and America going to war, the two largest superpowers on planet Earth, that could lead to World War III. So unfortunately, I fear the worst. I hope for the best. I think that, that there is a reason why everybody's so scared and you can't even buy a gun or ammo anymore because they're either sold out. In LA County, the LA sheriff actually literally ordered all the gun stores closed. Of course, now the gun stores and Second Amendment, proponents are suing the LA sheriff and the city of LA for doing this. But there's a reason everyone's so scared and stocking up on supplies, guns, ammo. Same thing with gold and silver. You can't actually get a lot of silver right now, even if you wanted it, because it's just sold out of most dealers around the country and around the world. So I don't know. I do expect this to be very difficult times. Certainly the most difficult times that anybody that's alive today has ever lived through. I mean, unless you were alive during the Spanish flu, which probably there's not anyone, maybe a few 100-year-olds are alive, but other than those few 100-year-olds, most people on planet Earth were not alive during the Spanish flu epidemic. So we've never witnessed what we're about to witness. But all we can do is do the best we can, protect ourselves, protect our families, stay positive, because getting negative and fearful is not productive.
Right.
And so, we going down that rabbit hole, which we all, at times tend to do, certainly doesn't help, so you got to get yourself out of that and say, all right, well, what can I do today? How can I, protect my family, my business, my employees, my tenants, and really work within what your constraints are in your community to do the best that we can to help one another get through this. If anything, it could turn into a revolution and bring the country together. I'm hopeful. Although, the country has been more divisive than it's ever been. But sometimes, like World War II actually brought this country together. We all banded together and we fought and we won. So I'm hopeful that we'll see that American spirit rise once again, because God knows we need it right now.
Yeah, absolutely, man. I know we could go on for hours and hours and hours, but we'll cut it off there. Just respectful of the time. Thank you so much, Mike, for being with us here today.
My pleasure. Thanks, Cecil. Take care.
You too.